What happens if London's money engine stalls? It has never truly stopped. Not in war, not in crisis, not in panic. But if it ever stalls, the world will feel in seconds. To understand what happens if London's money engine stalls, we have to understand what that engine really is. It isn't one bank. It isn't one market. It's a network of systems that clear trades, move liquidity, price risk, and translate global capital into daily reality. It is a machinery that makes modern money feel like a constant, reliable flow. And today, this matters because the world is more connected than ever. A disruption in one place no longer stays local. It spreads through markets like electricity. And London sits in one of the most critical positions in that network. The first beat of this story begins with dependency. Global institutions use London to clear trades, manage risk, and access liquidity. Corporations rely on London's markets to hedge currencies and interest rates. Governments rely on London's financial ecosystem to borrow, refinance, and maintain confidence. Even people who have never thought about the city rely on it indirectly, because their pensions, jobs, and savings are tied to global stability. London's engine is not just busy, it is structural. The second beat arrives with the illusion of smoothness. Most of the time, the engine feels invisible. Payments happen instantly. Trades settle. Markets open and close on schedule. The public sees calm because the system is designed to look calm. But calm is not the same as invincible. It is maintained. The third beat begins to form when you imagine the stall. Not a total collapse, just hesitation. Clearing delays. Liquidity tightens. Counterparties become cautious. Prices become unstable. And in finance, hesitation spreads faster than fire, because hesitation is a signal that trust is weakening. And once trust weakens, the machine doesn't slow down politely. It snaps. That's where this story starts to turn. Because if London's money engine stalls, it doesn't just affect London, it changes the rhythm of the world. Because the moment the engine hesitates, the system begins to behave differently. Finance is built on assumptions. Assumptions that payments will clear, that liquidity will be available, that counterparties will perform, that markets will stay open. London's engine helps reinforce those assumptions through routine. So when the routine breaks, even slightly, fear enters the network. The first layer of the reveal is that stalling creates uncertainty in settlement. Trades that should finalize begin to lag. Obligations that should be netted remain open. Exposure builds. And when exposure builds, institutions start asking uncomfortable questions. Who is safe? Who is over-leveraged? Who might fail next? This is where London's stall becomes contagious. Because London is not isolated. It is connected to global flows of derivatives, currency swaps, funding markets, and clearing channels. A disruption in one part of the engine forces adjustments everywhere else. Institutions begin hoarding liquidity. They tighten credit lines. They reduce risk. The system becomes defensive. Then comes the second layer, collateral pressure. When the engine stalls, the perceived risk rises. And when perceived risk rises, collateral demands rise. Margin requirements tighten. Cash becomes scarce. Assets are sold to meet obligations. Prices fall. Falling prices trigger more collateral calls. The loop accelerates. This is how a technical stall becomes a market event. The third layer is the most brutal. Liquidity freeze. Even strong institutions can fail if they cannot access cash in time. The system runs on short-term funding that must roll over constantly. London's engine helps that funding move smoothly. If it stalls, the funding becomes uncertain. And when funding becomes uncertain, trust collapses fast. Banks stop lending. Funds stop trading. Corporations delay payments. Markets become jumpy. This is where early conflict becomes sharp, because the world expects London's engine to be unstoppable. It has survived shocks before. It has adapted. It has been reinforced. So when it stalls, the psychological impact is enormous. It signals that the foundation is weaker than everyone assumed. And once the foundation is questioned, everything becomes fragile. The public may not see the machinery, but they will feel the outcome. Interest rates can spike. Currency volatility can surge. Credit can tighten. Businesses can pause hiring. Prices can jump. The economy can slow, all from hesitation. Because in finance, speed is stability. London's engine keeps speed alive. So if it stalls, the world loses more than efficiency. It loses confidence. And confidence is the true fuel of the machine. And when confidence is threatened, the system becomes brutal. Because modern finance is not designed to wait. It is designed to react. London's money engine sits at the intersection of clearing, settlement, liquidity, and global risk management. If it stalls, the world doesn't simply experience inconvenience. It experiences a chain reaction. The kind of reaction that spreads through markets faster than any human explanation can catch up. This is where the conflict becomes fully developed. The first wave is defensive behavior. Institutions begin protecting themselves. They reduce exposure. They demand more collateral. They pull credit lines. They stop trusting counterparties they trusted yesterday. The machine shifts from expansion to survival, and survival creates pressure. The second wave is foreselling. If collateral requirements rise, someone must find cash. They sell liquid assets first. Bonds, stocks, safe instruments. But selling pushes prices down, and falling prices increase stress. More margin calls appear. More selling follows. The stall becomes a spiral. Then comes the third wave, contagion. Because London's engine connects markets, not just within Britain, but across continents. A liquidity shock in London can affect dollar funding, euro markets, commodity hedging, and global derivatives exposure. Institutions in other regions feel the tightening and respond by pulling back as well. The system becomes synchronized panic. This is where the emotional buildup intensifies, because the public doesn't see the stall as a technical event. They see it as fear. They see it in headlines about banks under pressure. They see it in sudden market drops. They feel it in currency swings and rising costs. They hear vague phrases like market stress and liquidity concerns. But underneath those phrases is a simple reality. The machine is choking. And when the machine chokes, governments and central banks have only a few options. They can inject liquidity. They can guarantee obligations. They can loosen constraints. They can coordinate rescue. But each intervention has a cost, because intervention teaches the system another lesson, that it will be saved. And the more often it is saved, the more dependent it becomes on rescue. This is where the story approaches its peak. Because London's engine is not just a machine, it is a symbol of global continuity, a symbol that markets can function no matter what. If that symbol stalls, the world's belief system fractures. And belief is everything. Without belief, banks don't lend. Without belief, markets don't price risk calmly. Without belief, credit doesn't flow. Without belief, growth collapses. So the engine is protected at all costs. But protection creates fragility, because it means the system is running closer to the edge than anyone admits. This is the edge of the emotional peak. The realization that London's money engine doesn't just keep money moving. It keeps the modern world feeling normal. And if it stalls, normal disappears. That's the climax. If London's money engine stalls, the world doesn't just lose speed, it loses certainty. And without certainty, finance becomes fear. The engine is made of clearing systems, liquidity channels, settlement routines, and the trust that holds them together. It runs every day, quietly supporting global life. It keeps markets stable enough for salaries to be paid, for businesses to operate, for governments to borrow, for pensions to survive. So if it stalls, the consequences would not stay in the city. They would spread, markets would tighten, liquidity would freeze, risk would reprice violently, confidence would fracture, and the world would remember something it has forgotten. That money is not just value, it is belief. So the resolution is not hopelessness, it's awareness. The reason London's money engine matters is not because London is special. It matters because the world has built itself around interconnected systems that must keep moving. The engine is a reminder that stability is not guaranteed. It is maintained through architecture, discipline, and constant trust. And today, that lesson is urgent because finance is becoming faster and more concentrated. The systems are more automated. The stakes are higher. The margins are thinner, which means the next stall could arrive with less warning and spread with more speed than ever before. What happens if London's money engine stalls isn't just a theoretical question. It's a mirror, a reminder that the modern world runs on invisible machinery, and that machinery can fail. Sometimes the smallest shift in perspective becomes the beginning of a new future. What happens